Hey everyone, happy Wednesday. Hope you are well. Another edition, #AskRobCo with James Wild. Very exciting week, super busy, lots happening. Lockdown or whatever it was is virtually over. Ticking off all the boxes at the moment, playing football again, tick, seeing family again, tick. Now eating inside and outside of restaurants, tick. James, have you done all of them? Some of them? Where you at with all of that?
Yeah, thank you, Rob. Done most of those so far. Strong favour of eating inside at the moment, especially with the unpredictable downpours we've been seeing.
Absolutely. So lots and lots happening in the market. Activity is going extremely well. Things are going really busy. Let's head straight into the numbers and understand what's going on, because we've got some interesting changes this week. So if everyone wants to open handout number 1.
The new instructions got 386 with the sold price, sold data going up to 179, I believe, this week.
Great. So really big increase. Well, a bit of an increase in terms of instructions. So that's good. The sold numbers have seen a big increase. Where has that come from? What are we putting that down to? Is that what we expected? Talk us through that, James.
Yeah, I mean, as we've been speculating for the last few weeks, we did anticipate more activity in the market, especially as we get through to the mid to late month of May, especially with that stamp duty holiday on the first 500,000 pounds of purchases. So that saving, like we've said, the saving is approximately £15,000 if you're buying a property of £500,000 or more. So a significant saving for those sort of owner-occupier buyers, as well as those buy-to-let investors, with that discount boosting their potential yields, which they're working off. And obviously, we're in a time-limited market here, with the end of this scheme coming to a close end of June, with the long stop of a slightly staircased holiday on the stamp duty coming to end at the end of September 2021.
Brilliant. I mean, I do find it really fascinating, that change. I was expecting it over the last few weeks, and I was expecting this upturn to happen. I'm just surprised that it happened in one go, and whether that's now going to be the platform of what happens moving forward. I just find it fascinating that the upturn in a space of a week is quite big. And does that have legs, and is that the new platform for the market? I'm really intrigued. I mean, what I'm seeing just on this week and speaking to the agents, there is a flurry of offers, a flurry of interest, a real heat to the market, let's just say. So I'm not surprised that we've seen those kind of numbers, in the sense of the volume of valuations that we're doing, and the volume of work and activity that there is in the market. I'm just surprised that we've gone through this 6-week period where the volume of transactions of exchanges was quite low compared to what we were seeing last year, and then boom, this week it's gone right back up. And I think that is a massive change and a tipping point for everyone to understand. It's what I believe should have been happening, but for whatever reason we weren't seeing it. So I think that's super interesting. Anything else from the data that you want to add that we've just missed out, James?
Yeah, I mean, just to add to that, I mean, this is the first week where we've seen a real uptick in the number of sold transactions. I mean, what I would say is our data, it's very raw data. It's not seasonally adjusted and smooth, such as the data which the Land Registry produces. So there is potential to have slight weeks which see more heightened activity than other weeks. But hopefully it's the start of the market gaining more momentum, and we're actually seeing some of those properties which have come on the market moving through into sale and transaction.
Brilliant.
So let's see what happens in the coming weeks of May.
Great. We've got a special last-minute guest today. I've told everyone that we're doing buy-to-let special this week. So we've invited Shrena Patel from Octane Capital, a real specialist in everything to do with lending, product, especially buy-to-let is one of her key areas. So bit of technology issues and technical issues. I don't know if Shrena's there or not there. So hopefully she is. Shrena, are you with us?
I am. Can you hear me, see me?
Brilliant. We can actually hear you and see you loud and clear. Welcome, Shrena. I really appreciate you joining lastminute.com. So we're going to just run with this, and I'm super happy that you're here because you've got so much value to add. Everyone listening, Shrena is an expert in the buy-to-let area, lending product. She's a real all-round specialist. And as I told everyone last week, we said we wanted to spend the next 15 minutes on really giving you an update on the buy-to-let market, what we're seeing, the trends that we're seeing. And I think James can intro the sector, and then we'll listen to Shrena on the back of what everything James says.
Yes, thank you, Rob, and welcome, Shrena. Just in terms of sort of kicking us off, we've got a few handouts, and one of the first ones I wanted to touch upon was some of the rising property prices that we've seen in the UK. I mean, largely nationwide, we've seen price increases, but these have been largely focused around the northwest of England. So we've got a nice graphic in handout 2, which just highlights in a darker shade those areas which have been experience the higher property price growth, with those in the northwest, Manchester, Liverpool areas achieving 6 to 8% growth in the last 12 months. This is a case of some buyers are moving out of the London market, going over to more regional locations across the UK, and it's whether we could get a view on whether these investors are now having an eye for more capital appreciation in these more regional areas, and that's going to be coupled with the fact that they're getting stronger yields, higher yields than they're getting here in the southeast and London. So it's a real sort of, it's sort of the benefit of the high yield coupled with capital appreciation. So is it win-win for those buy-to-let landlords moving out of London into the northwest?
Yeah, I'll give you my view on that, and then Shrena can step in. It's very clear that central London rental, both demand and pricing has come in, which has meant that the investment market, specifically buy-to-let, has wanted to look for those better returns and potential capital growth, which has led to them seeking opportunities in other areas of the country at lower price points, at better returns, better yields, better rents. And so for me, on everything that we've seen over the last year, nothing surprises me that there is a demand outside of London, in the north of England, in certain areas, from buy-to-let investors, because they're getting their capital growth, they're getting strong rental income and returns, and they haven't been as hit as badly by COVID and the office stroke city market. What are your views on that, Shrena?
Yeah, I'd probably echo what you're saying there, because as you know, the yields in London, landlords are seeing 2.5%, 3% at the moment, so it's not as lucrative as it may have been. Also, you're seeing like more investors coming in, or first-time landlords who are trying to build up their deposit, and buying in London is just not an option for them. So what they do is move further out into the north, because they can probably buy more properties with a smaller deposit. So we're seeing a lot of that, a lot of increase in the properties up north versus London. London, we're seeing a lot of refinances. So a lot of people want to get out their capital at the moment, in terms of either add value to their current portfolio, or maybe also diversify a little bit and maybe move into the north as well. So they have a bit of a split in diversity. So yeah, definitely, agreeing what's happening, and there is a bigger growth up north.
Yeah. Thank you, Shrena. We've got a graphic on it's labeled graphic 2, but it's the third down, and it's just a graphic which highlights some of the supply-demand ratio from in terms of the prospective tenants to the housing stock. And as you can see there, we've got London towards the bottom and some of the more regional districts of the country higher up on the list. But across the board, nationwide, landlords have seen a big loss of income in the last 12 months, with some tenants being unable to afford their rent. Landlords have had rental voids, coupled with a ban on evictions. So they've been under, extreme pressure in terms of their portfolio. Landlords are more than likely to be looking to potentially recoup their losses with possible rental rises as the year goes on, and possibly adapting their properties to try and boost their yields in terms of maybe adding a bedroom, creation of possibly HMOs. But notwithstanding this, Rob, do you think the end of the furlough scheme in September could affect the rental market at all?
I'm not sure that the furlough scheme itself, or also the stamp duty scheme in relation to acquisitions, will affect the rental market. I think there's a broader economic situation with the rental market that if in June and July, or as we're seeing now, everyone's going back to their offices and they're confident in their job position, that then they can start thinking about moving again, which might mean relocating, or it might be negotiating a lower rent because pricing has come in. So I think the trend will strengthen even more once someone has job security, or has a job if their job isn't given back to them. So I do think there is something tangible there, James, that when furlough ends, the fact that someone either has job security or a job to go back to, or finds a new one, will accelerate whether someone then moves properties or stays where they are. So I just think the broader economic position and the confidence that will grow as the rest of this year plays out will fuel rental demand and change and relocation, along with job security, which is really important. How do you see it, Shrena?
What I would add is with the COVID and then, lower rents and some landlords negotiating lower rents and new tenants coming in wanting lower rents just because the market has gone down in rental. What we're seeing as lenders is some of these landlords are not meeting the normal stress test. So the rental's not actually fitting anymore in terms of that 125 or 150 times cover. In terms of what we do is we do 100 times cover. So it kind of helps a lot of those low yielding properties. So we're able to facilitate. But I think as rental yields go down, it's going to be harder for those, landlords that have got highly leveraged portfolios to refinance if their term comes to end. So we're hoping that, rents will achieve and get to where they need to be just for the sake of being able to keep that portfolio geared to where it is. But yeah, I think once, with the opening up and then the more confidence coming back into the housing market in terms of the rental side, we can only hope that rentals will start increasing, and that shouldn't then be an issue in effect, basically.
Yeah.
Thank you for that. Really important. I think that point's really important, Shrena, that the nuance and the split of the market, where you've got certain investors now leaving the market and saying, I'm not getting my capital growth, yields have compressed, rental income is getting lower. Then in the changes in the regulations about offsetting mortgage payments, etc., against your income having changed, that the pressures and the demands and the requirements for a buy-to-let investor in 2021 are probably the most challenging that I would have seen in the near on 30 years that I've been in the industry. And a lot of old school investors are just saying now, you know what, this isn't for me. I just can't make this work. I've had a great run over the last 10, 20, 30 years. I'm now going to sell off and think about putting my money somewhere else. That's something I'm seeing the whole time. It's a reflection of the marketplace. It doesn't mean there is an opportunity. It doesn't mean you can't make it work. It is harder than ever before, Shrena. What do you think about that?
Yeah, we're definitely seeing over a lot of investors are either offloading their assets, just like you rightly said, it doesn't make sense. If they've got a big enough portfolio held in their personal name and it makes sense to incorporate into a limited company and they can kind of prove the aspects of saving that, stamp duty, capital gains, they are doing that as well, but it has to be worthwhile. So if it's not worthwhile, we're seeing a lot of assets being offloaded, and it does make sense. If you can't offset your interest anymore and you're not making the income you was, it's not worth it for some landlords. So yeah, definitely seeing a lot of rejig in terms of people's strategies.
Yeah, so we've seen sort of buy-to-let landlords asset stripping those lower yielding properties over the course of the last 12 months. But with landlords obviously taking a big hit in the last year in terms of their rental receipts, and with some areas, certainly in London, suffering some rental pricing falls, coupled with, like you say, Shrena, the sort of impact on the affordability criteria and rental coverage required for some of the buy-to-let mortgage products, has this impacted pricing in the market at all in terms of those buy-to-let offerings?
I suppose different lenders have taken different approaches, and pricing is usually based on your leverage. So if you are now having to go higher leverage, your pricing might be higher. If it's more trickier of an asset, you might also get more expensive pricing. But there's also, rates have come down slightly due to the fact that, Bank of England base rate dropped and just the economy itself. So depends again, as I said, on lender by lender, but there is the opportunity to get the cheaper rates as well as the higher rates, depending on where you're sitting in that spectrum as a borrower, your type of asset. But broadly speaking, I haven't seen rates go high. It's more they've come down.
Excellent, thank you. Just moving on, we did mention about the unemployment and furlough coming to end. I've got a graphic forward in terms of the unemployment. Now we're currently at 4.8% unemployment here in the UK, with there being forecasts of this rising to 6.5% come the end of furlough. And I think these forecasts have been downgraded and softened slightly with the improving economic conditions and obviously the rollout of the vaccine here in the UK. I think this is positive news. We just look historically at that. We see in sort of the period of 2012 that the unemployment rate is far higher than the sort of current forecast figures. And I think that's sort of holistically in the property market and the wider economy is positive news as we continue to come out of the lockdowns and unlock the country back into normality per se. Let's move on to how the market has adapted and reacted in the last 10 years to the changes and the evolvement of the market. In terms of the rental stock, the number of people renting, we've seen the emergence of the build-to-rent sector, private rental sector. We've seen a huge influx of those entrants to the market, building, multi-story blocks here in London, and there's been multiple in the Midlands, in Birmingham and Manchester, largely centred around city centres. As we are at the moment, we've got stronger regional growth as investors, like we mentioned, seek to boost their returns and yields, moving out of London into the northwest, as we mentioned. And just an analytical point here, in terms of given the low rental yields we've seen here in London, landlords have adapted their properties and moved more into the HMO market. Is that a sector of lending, Shrena, which you've been heavily involved in?
Yeah, so we do a lot of HMO stuff, especially with landlords, as you said, converting their houses into kind of HMOs just because the yields are so much better if you're renting out 4 or 5 rooms. Obviously, there's, regulations and licenses that are required to have certain types of HMOs, depending on the number of beds, depending on the borough. You may need planning, you might need licenses. But a lot of people have changed, as I said, their strategy from going from a single, vanilla one AST occupancy to that kind of multiple occupation just to get that yield in. So definitely seeing a lot of that. We do a lot of, as well as the buy-to-let side, we do refurb bridges. So we do a lot with landlords on those kind of products where we help them convert their house, give them the funding to be able to convert it as well. So it kind of helps them being able to kind of elevate their strategy. So definitely seeing an uptick on HMOs. I'd also say in terms of just to talk about in terms of the demand for properties at the moment, just like you said, these developers, they're churning out these properties, which, to be fair, if you look at auction purchases at the moment, for example, you'll probably have 50 or 60 people trying to go to that one property. So in terms of the demand, it's not there. So it's a really good time for the developers if they, can build out, can, get the stock out there. It's a buyer's market at the moment. There's so many buyers, especially due to the stamp duty extension, that are trying to find property, and they're finding it hard because there might be 6, 7, 8 people going for that same property, and especially with all those, if we just go outside the buy-to-let, but all those government schemes that are bringing all these first-time buyers into the market, there's not enough stock versus the demand. So developers at the moment are kind of taking advantage of being able to kind of get good pricing and good sales as well.
Absolutely. I mean, we're seeing that throughout. It's the message that we've shared for every week for the last 4 or 5 weeks. There just isn't enough stock. The agents want more and more and they can't find it. The developers obviously can't build quick enough. And if they had, in hindsight, not slowed down their building and construction during COVID, they'd have even more stock that they would want to release now that they can't move quickly enough on. And going back to the HMO and the development of maybe more light development of property, we've championed that product this year. Why? Because we're just seeing so many HMO valuations, and on the back of the more nuanced buy-to-let market now. And what do I mean about the more nuanced, sophisticated market? It just isn't the simple game of rocking up, renting and getting your capital growth and returns like it used to be 10, 20, 30 years ago. All of the tax changes, all of the implications, all of the competition have changed that dynamic. It is still possible to get capital growth and good yields and good returns, but you've got to be on your A game. You've got to be a sophisticated or very smart, intelligent investor to reach out to those opportunities. Whereas anybody and anyone could have done it 10, 20, 30 years ago and just relied on rental growth, which has always been relatively good, and capital growth, which would always help you. That's just not the situation now. And moving forward, you can see the amount of people coming into the buy-to-let market compared to going out is nowhere near the levels it used to be, by thousands. And that is because it's more challenging. And every marketplace needs this disruption. You can't just have more people going buy-to-let, buy-to-let, buy-to-let. It's so easy. I'm going to make some. No, you need your disruption. COVID has created that, and it was going that way anyway. Let's be really clear. The numbers were in decline because it was more complicated. Now it's gonna lead to, unless you're good at it, unless you know what you're doing, unless you know how to make money, like you, Shrena, with all due respect, because you're a sophisticated lender and buyer, you know what you're doing. Unless you know what you're doing and it's very well planned and calculated, you're just not going to make money. And that's going to be the big changer now, Shrena.
Yeah, no, definitely agree in terms of that. And, I've been in, a few conversations with you, and you see there's so many people that are changing what they're doing. They might have been that, buy-to-let, individual that will hold their properties, but now they've changed their whole strategy to say, okay, I'm actually going to now get rundown properties, do it up and then flip it because it just works better for me, tax implications, etc. So you are seeing that evolution of that, borrower changing in terms of what they used to do. So definitely echo what you're saying there, Rob.
James, what have we got to close out this week?
Well, here in London is obviously there is a sort of housing shortage in most London boroughs as we sort of move across the sector. This is helping to fuel some of the market growth we've seen here in London. Obviously at more subdued rates to what we're seeing in the rest of the country. And like you say, Shrena, I think this is going to put a lot of pressure on house builders, the delivery of new homes, the pressure, the price sensitivity on sites. We're going to see multiple bidders for not only turnkey houses, but possibly on development sites. And maybe this current shortage is going to promote more of the buy-to-let landlords to move into that build-to-rent. Maybe they will commission a contractor to build that small block of flats or develop it themselves. So like we touched on before, I think the market is evolving and reacting to some of these market pressures.
No, they definitely are. In terms of your typical developers that did want to sell properties, as much as there's a market for the sale aspect, because they're not getting the pricing they also want, some of them have actually decided to hold for a while as well. So you're seeing a bit of a shift, because as much as there's so many people out there to want to buy, they might not be, pitching at the right price. And if a developer's got a development facility that needs to be repaid, there's only so much they can give as a discount on the sales, basically. So you are seeing a bit of, some that will sell cheap because they just want to kind of get out of that project. And then you've got some that will sell a few, some will hold a few. So you are seeing a great mixture, basically, in terms of what they can do to kind of get themselves out of their back end facility that they may have had. But there's definitely opportunity, as you rightly said, in terms of the properties available out there and to kind of sell as well as hold.
Outside of that, Shrena, very last comment from you, because we know you're super busy. You've come very last minute, and we're really appreciative of that, and great to hear your input. Any other lending trends or opportunities or anything that you're seeing that you want to share with us that we haven't mentioned so far?
So we're seeing a lot of below market value transactions as well, where people are kind of trying to sell stock but not wanting to go to estate agents. So you might just get transactions done without that need. So we're seeing a lot of those. We're seeing portfolios being offloaded, like I mentioned as well, where it's just not feasible anymore. But we're seeing a lot of added value stuff. So landlords, investors, developers who have got a portfolio or have properties and they just want to increase appreciation. So they might want to add another bedroom, a loft conversion, a lot of PD stuff, as things have changed in the PD schemes. A lot of people are doing office to resi schemes as well. So seeing a lot of that, and I think with the E-class changes as well, you're seeing a lot of people taking opportunity on that because it's made it easier to go from one class to another. So seeing a mixture, and commercials coming back in. We don't do much commercial. It's not our bread and butter. It's residential, but we are seeing a lot of commercial going into resi, which is a good sign as well. So yeah, that's it really.
Brilliant. Thanks, Shrena. James, thank you so much for this week. Great input, great data, great intel. Thank you everyone for listening live or watching afterwards. Really appreciate all of your help and support. Things are moving fast. This industry is moving week by week by week. The data and the intel and the feel that we get on the ground from the activity that we see is really driving what we're producing for you and what we are giving you. And we are super supportive for you joining every week. And we will keep sharing with you great content, great value, great data, great intel, and tell you what's happening on the ground every day of the week as we see it in the property market with lending, sales, risk, sanction, credit, and so on. So thank you, everyone. Shrena, you've been amazing for dropping in lastminute.com. Superb input and content. And we will see everyone same time, same place next week, every Wednesday, 1 p.m. #AskRobCo. Keep supporting. Thank you for watching the podcast as well. Thank you for watching on YouTube, and thank you for all your support on all of the socials. Take care, everyone. Thanks, James. And thank you so much, Shrena. Appreciate it.
Thank you. Thank you for having me on.
You're welcome.